Cool. Welcome to Think Beyond the Keys. And just a minute, sorry about that, just a little bit of technical difficulties. There we go. I hope you can hear me, but welcome to Think Beyond the Keys. This is Melvina Fredson-Cole, and today I am excited because I am going to speak about down payment, the myth that's going around about down payment. Now, I know most of my audiences already know that this is just a myth and it's not true. And it is you have to have 20% of the purchase price upfront in order to buy a home. But believe it or not, there's still many people out there that do think that you do need 20% before you can get a loan to purchase a home. So what is the down payment? So let's talk about that just a little bit. What is the down payment? When you look at it, it is the amount of money that upfront that you are going to invest towards the purchase of a home. That's your investment that you're bringing to the table. It's a contract, right? And you're saying like, Mr. Lender, I am going to put this much money so that you can loan me this much. So for example, if a home costs 500,000, right? And you come in and says, Mr. Lender, I am going to put down my 20%, which is 100,000. So I'm putting 100,000 into this contract and you are going to loan me for 100,000. Now, what that does to the lender, one, it shows the lender that you're disciplined enough to have saved that much money, unless obviously it's a gift, right? And number two, it gives the lender, it provides the lender some kind of security that, he is not going to default to the loan because he has his own investment in it, $100,000 in it. So there's a likelihood that he's not going to default on the loan. And just a side note on this point, a lot of homeowners now have a lot of equity in their home. So there is a really small chance of people defaulting and going into foreclosure. I think people are smart enough to sell their home now before they go into foreclosure. So this is just a little side note on that point, why, yes, we're not seeing people like selling their homes, or one reason about that is they already have equity in their home. So they're not gonna wait until they go into default. If you have $100,000 invested in your home, you're not gonna wait. If something happens to your job and you see that you're going behind, you're gonna hurry up and sell. So you can get 100,000 out, plus even some of the equity, the growth, because we all know that home prices appreciate and it has been appreciating, right? So that makes sense, right? And but the challenge is majority of the people are not able to save the 20%. So in this example, the 100,000, it may not be, a lot of people are not able to save it, and you'll be sitting renting and renting, paying someone else's mortgage for years and years and years to get to that point, right? Depending on what your income is or if you're in business. So let me tell you something. There are lenders that are willing to loan you money as low as 3%. And it depends. When you go shop for loans, there are different type of loan products, right? You already know that there are different type of loan products. So there's some loan products that can lend you less than 20%, as low as 3%. So let's look at the common ones, the ones more that you will find out there, right? You have government loans, you have FHA. FHA can go as low as 3.5% for a 580 score, FICO score. And they can do, I think that if you go below that from 500 to 579, they can loan you money. You have to come up with 10%, but we'll talk about that, why it's not, you really need to try to get a 3.5%, okay? They have another government loan is VA, but that's for only people that are in the forces and their spouse. And VA is a whole different beast when it comes to lending. And I am going to cover VA loans next month in November. So stay tuned. And you have USDA, and those are more for rural areas. And both of these, the VA and USDA, is zero down payment. So that's good to have zero down payment, right? All right. But let's look at conventional loans. Conventional loans like Fannie Mae, Freddie Mac, they require at least 3%. However, the minimum credit score is, I think, 620. And then if you want jumbo loans more than the minimum, I think if it's 760,000 in some areas, more than that, it's a jumbo loan, and so it's 680. So these are the different programs that out there that you can get that can have a low down payment. So what are the benefits though? What are the benefits of putting down 20%? Let's just say that. Let's just look through the benefits real quick. One, you avoid mortgage insurance. I'm sure you've heard of MIP mortgage, private mortgage insurance, different things that's out there. And that is premium that you will be paying in addition to the mortgage and interest rate combined that you'll be paying on the loan. And depending on the lender and depending on the program, the mortgage insurance, and depending on the amount you loan, the mortgage insurance is usually between 0.5 right up to 5% of the loan amount. And they calculate that and divide it by 12, and monthly you are going to be paying that until you have reached the 20% mark, the 80% loan to value. And what that is, loan to value means the percentage point between what your investment is and the cost of the home. So in our example, you are putting down 20% of the cost of the home, right? And so your loan to value is 80%. If you're putting down 3%, your loan to value is 97%. And so they normally we normally speak about down payment in percentage terms, okay? Another advantage of putting down 20% is you have better mortgage interest rate. The more you put down and the better your FICO score is, the more likely your interest rate will be so much better. And then number 3, you have lower upfront cost and ongoing cost. Obviously, just like I said, you won't have that mortgage insurance to be paying every month because you put down 20%, but we've spoken about that. It is not a lot of people are not able to put that. So that brings me to good news. That means that the US Department of Housing and Development, that's HUD, they have put aside, they provide state and local organization nationwide funds that they in turn help people bridge that down payment gap. So there are programs out there. In Santa Clara County, we have, I think, the 2006 Measure A Affordable Housing Program in 2016. We're able in Santa Clara County, they're able to offer home buyers like a silent second. We're up to 17% on some of the programs. There are 3 programs out there in Santa Clara County generally, and those are, one of them is called, I just drew a blank, but it loans up to 17% of the loan value, and it is for low to moderate income buyers. And that includes, and some special groups, teachers, healthcare workers, those kind of stuff, those kind of people, that is for them. And that program is really cool. But however, it is important to ask your realtor or your loan officer, because you have to go through a class that gives you the details about the program, because that 17% actually is you don't pay interest on it, you don't pay monthly on it. It allows you to eliminate the mortgage insurance. However, what happens if you decide to refinance or sell the home, you have to pay the 17 plus you have to pay 17% of whatever the loan amount, the appreciation amount. For example, if they if you decide to ask for 17%, which is the highest they go, and when you're selling your home, you're paying them back that 17%. And then you are paying them 17% of the appreciated value of the home. And so you're kind of like sharing the equity depending on how much you loan. And so there are other little things on the program, but it gives you the ability to save. It gives you the ability to be a homeowner. We all know the advantages of that, the advantages of accumulating wealth and all that kind of stuff. So at least you do not, there are a lot of people there who may not be able to save that 17%. It's better for them to use those programs in order to be a homeowner. But that brings me to another point. It is important for people out there to not rely just on Google and just on their own research. It's important for you to do it so you're educated, but you need a team that has a real estate agent, that has a mortgage loan officer, financial advisor that can help you, because every person's situation is different. There's no one person's situation that's different. And I can cover so many scenarios, but you'll be bored. Okay, so this is just a general overview, but you need that team to start. And now we're finishing 2020. If you're still renting, don't assume you will not be able to purchase soon. Do not, because there's so many programs out there. There are programs depending on your county, there's city programs, and even depending on your profession, there are programs out there that help. And with seller concessions, everything, there is a package for you to become a homeowner. So what can you start? That's number one, get your team together. Number two, start putting money aside for your home purchase, for down payment and closing costs. And it can be as little as whatever you can. Put it on automatic savings. Put it on automatic savings. Speak with a financial person for the best savings program out there that you need based on your own situation, and start doing that automatically. That's important. Number two, know your FICO score. Know your FICO score, and then work with your the loan officers and realtors. They work with the credit companies. There's so many out there, but again, there's so many out there also that may not be working to your advantage. So that's why you may want to go through your loan officer to see which one will help you the best. So does that make sense? I hope that helps someone out there, that yes, you need at least your own a small amount of money to bring to the table. However, if you don't have that, there are programs to help you with that, help you with closing costs so that you can be a homeowner. I am excited for the next few weeks because I'm going to have someone from a credit company come and speak, someone from financial come and speak, to help you finish this year strong and get ready and launch into ownership. It may surprise you. You may be able to buy a home and be in your own home for Christmas. So Operation Christmas Home Ownership, let me know if you're interested in that. So I hope you have an amazing week, and I'll see you next week in Think Beyond the Keys. Take care.